Sir, there's a GC right there, Cliff.
Go.
It's piers. We got concrete piers and wood piers.
Yes, sir.
Checklist. Check out the checklist. We
Yes,
got it for everything we need.
Yes, sir.
Right, you forget some things sometimes.
Mhm.
So this is going to outline, make sure you hit every single thing. What's the foundation, plumbing, electric, painting, flooring, everything. So you don't miss anything.
Okay.
You want to make sure you get all your checks.
Okay. I want to introduce you guys to Cliff Hunter. Cliff is a world-renowned flipper. He actually flips. He's also a GC as well. He's a good contractor. When it comes to all of our renovations, all over the nation, you'll talk to this guy right here.
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partner Dale back in the saddle again for another edition of the forgive me, guys. The Investors Edge podcast, guys. Here on Friday, we talk about all things real estate, guys. If you could do me a favor, guys, like, share, and subscribe. It's going to be me today, guys, on the day after my birthday, guys. Your boy 47. And so that's all good and gravy. I've had a good day today. It's been a long day. I had a migraine, but it's all good. I'm back in the saddle, guys. If you could, guys, do me a favor, like, share, and subscribe. And if you are on a platform that you have to click on that bell, do me a favor, click on that bell, man. So when me and Cliff come live, it's going to be about this. It's going to be me today, man, because Cliff is taking care of his dog. Be praying for his dog, man. His dog is going through some rough times, man. Cliff and his dog. But it's all good, guys, man. I hope you guys had a wonderful Friday, man. Let's just jump into topics, man. Here are our topics for today. Let's get it going, guys. 1 second, let's get it going. Boom. Topics for today, guys. It's going to be really good. Number one, guys. This is a housing market update. It's all about housing today, guys. For those that are wanting to know what's going with the retail market when it comes to buying a residential house, today is your episode. Come get it in with your partners, them guys. Number one, we're going to do this here, guys. DR Horton, which is a major builder, is sounding the alarm on what's going on in the housing market. Number two, the Fed hits pause again on fair rates. What does that actually mean for the market, and what does it mean for buyers? Number three, guys, because of what's going on in the market, the biggest bargains since 2008 are here. We're going to talk about how you can locate some real estate, guys. I told you guys last week we were going to talk about distressed property investing today, guys. Yes, this is going to be a good one. So get your pens and pads out and check this out, guys, if you don't mind. The first topic we're diving into, guys, is DR Horton. I think they're the second, or either larger or the second largest home builder in the United States. They're sounding the alarm. They're saying, man, there are a lot of cancellations going on, y'all. A ton of cancellations going on. These are the questions we got to ask. Let me get my little notes out real fast. Number one, guys, here we go. Why buyer cancellations matter, what affordability pressure is doing to new construction, and what builders may be telling us about the broader housing market. In other words, home builders are struggling a little bit, y'all. Struggling. They are giving out a lot of deals, which is crazy. Again, I'm gonna tell you the deals that I had know about. Again, my aunt has bought a new construction home about 4 or 5 months ago, right, in H-Town, and it was new construction. This is what she did. She went and saw it, which was fine. All the appliances were there. We're talking about Viking level appliances. Viking is a manufacturer brand, which is pristine. Those are there, that type of appliances. We're talking about a stove. We're talking about microwave. We're talking about refrigerators, you name it. They're all there, guys. Now, watch this, guys. Watch this. All she did was put down earnest money of about $3,000. And because of all of these incentives that was going on, she got into the property for 100% financing. But Dale, you say she put down $3,000 for earnest money. Oh, at the closing, they got that money back. And it was a FHA loan product. What you say, Chuck? Yeah. Again, guys, let's dive into it real fast. Let's bring in our brothers from Reventure out real quickly. So we can see what's going down. And let's see what he's saying about the entire system. What's going on, guys? I think you're going to love what's going on. Let's get it in. Let's go in. One sec here. Let's dive into it. Let's get to it.
America's number one home builder just sent a shocking warning to the U.S. housing market and economy. While many people believe that the housing market is still growing and that home prices are not dropping, this home builder is reporting something that should worry every home buyer, owner, and investor. They're D.R. Horton, and they just lowered their revenue guidance as sales came in flat, with the company's contract cancellation rate spiking to 20%. This comes only 1 month after America's second largest home builder issued the same warning, with back in June, Lennar cutting their full year target, citing stubborn housing market headwinds. And what's really interesting about these two home builders is how dominant they are. According to Builder Online, in 2025, D.R. Horton had 87,000 closings, while Lennar had 82,000. They were number one and number two among home builders. Number three was Pulte Group, who only had 29,000 home closings, and number four, NVR. So D.R. Horton and Lennar have almost 3 times more closings than the number 3 and number 4 builders. And actually, they account for almost 25% of the home building market. So their warnings pack a lot of weight. And what concerns me is that there's a lot of people in the housing market who seem to think that there's no downturn and who seem to think that prices won't drop. However, these two home builders have already cut prices significantly. Lennar has cut their net selling price by 25% from the peak in 2022. Literally, Lennar's prices today, net of mortgage incentives, are lower than they were back in 2018, 2019. Meanwhile, D.R. Horton has cut prices by 12% from peak. And despite those price cuts, these builders are still having major challenges. And one reason why is inventory. This graph is looking at the months of supply on builder lots across the U.S. This includes Lennar and D.R. Horton, as well as all the other builders sampled by the U.S. Census.
Got a question on Instagram, guys, from Melody. Melody, what this kind of means real quickly is D.R. Horton right now, what they're doing is they're sounding the alarm on what's going on for buyer cancellations. In other words, what buyers are doing is the buyers are saying, hey, we are going to back out of this deal. And to be honest with you guys, when they back out of deals, when it comes to new construction, normally when you put down a deposit, that deposit is foregone. You don't get it back most likely. You don't get it back. Now, why would a buyer put down a deposit knowing that they won't get it back? What are they seeing that's not good? Just saying, guys. Just saying. If you bought a property from Lennar, great. Lennar is the second biggest builder in America. Great. Hope you got a good rate. Hope you did. But they're giving out so many incentives, guys. It's crazy. Let's keep going, guys. It gets deeper. Let's get into it. Here we go.
Census Bureau. And what you can see is that today there's over 9 months of supply on builder lots, meaning that it would take 9 months to sell all the current inventory at the current monthly sales pace. You could see that the long-term average is only 5.8 months of supply. Today's supply is about 40% higher than normal, which is why these builders are having issues.
Guys, listen to that. 9 months. 9 months, guys, to sell a home. That's a long time for new construction, which means, let me kind of get, let you guys know what's going on with new constructions, what they do. With new construction, this is how they normally do it, guys, all right? Is they normally get construction financing at a reasonable rate because of their sheer volume, right? They're a huge distributor of homes, builder, right? And it's interest only, or IO, and it's normally a 15-year term. And they're constantly building because they have to put that money to work, right? Now watch this now. They're borrowing from a credit facility to build these homes at let's say 5% interest rate, 5%, right? Let's be reasonable, 5%. And they build it. It takes them about 6 months to build it, right? Let's say payments don't start to be paid until it's finished. 9 months after this, guys. 9 months is what that's what happens. They have to wait 9 months to build this. This is to be able to sell it. This is crazy town. Let's keep going though. Let's keep going. It gets better. It gets better. Let's just keep going. Come on.
And issuing these warnings. Now, interestingly, the only other times that we've seen supply this high are recessions in U.S. history. We have the 2008, 2009 financial crisis back where months of supply hit 11 months. Then we have the 1981 double dip recession where months of supply hit 10, and the 1974 recession where months of supply also hit 10. These are the only other periods in U.S. history other than the 2022 to 2026 period where builders have had this much supply on their lots, begging the question, are these builders also suggesting that maybe an economic downturn could be coming about in the future as well? But the thing is, this data for D.R. Horton could have been even worse, because when I dug into their earnings report and I dug into their supplemental data, I found something that absolutely shocked me and suggested to me that while D.R. Horton's report on their earnings in 2026 wasn't great, it actually might be propped up by the fact that D.R. Horton is now starting to engage in riskier lending practices, and it's starting to support their sales orders by shifting the mix of who they sell homes to. And this is something that I think could have a massive impact on D.R. Horton as a company, as well as their communities going forward.
Guys, this sounds a lot like 2007 and 8 from a lending perspective. Those that are financially astute in the mortgage arena, we all know at the type of loans that these Bammers were giving out. Ninja loans, right? Interest-only loans, adjustable rate mortgages, and giving 99.7% of the loan, and all the buyers bring is 0.3% in a down payment. 0.3%. Wow. Let's go.
In terms of how they hold value. Because when I dug into their supplemental data, everyone, I went to the last page. And this last page looks at select DHI, which is D.R. Horton mortgage data. And this is showing something astounding, that in the third quarter of 2026, which is really the second quarter, ended in June, D.R. Horton had an 82% capture rate. What that means, capture rate it's the percentage of total home closings by D.R. Horton's home building operations for which DHI Mortgage handled the home buyer's financing. And what DHI Mortgage is a mortgage lender subsidiary of D.R. Horton. And what this data is showing is that they financed over 80% of all their own closings in the most recent quarter. And you can see this has been something that D.R. Horton has been programmatically doing over the last decade. About 10 years ago, they were only financing about 50% of their own mortgages. You can see that that's just gone up, and up over the last decade, particularly after the pandemic started, to now 82% of D.R. Horton's homes are self-financed.
Wow. Melody, I'll get to the question in a second. I got your question. Guys, listen to what they're self-financing. 80% north of that, of all of the closest. What does self-financing mean? What that normally means, guys, is incentives, or they will finance out the home and keep it on their balance sheet, right, before they actually sell it off to the secondary market. One of the two of those. Because then what happens is Melody has a question on Instagram. She says, wait a minute, Liddell. And it's a phenomenal question. She said, wait a minute, Liddell. Hold on. they usually build 2 and sell lots before it's even built. So I wonder why 9 months. Great observation, Melody. You are correct in a normal market. Now what they're doing is they're having to build 2, 3, 4, 5 homes, right? To put that money to work before they're sold. Because if they wait in this market till someone comes and buys said lot, normally they're sitting on money that they only have a allotted amount of time before they have to begin making payments. There's certain covenants in the agreement with their lender, who's giving them the construction loan to construct, right? To construct after they normally get a buyer, but buyers are not coming. Hence the incentives. Hence them having to self-finance out. So no, you are correct. In a normal market, this is a stagnant market. So they can't just wait till somebody comes. Like this is, and this is the first time that I've watched this all the way through. Yo, this is giving me 2008, 9, and 10 vibes right now. Like this is getting, when home builders do this, guys, home builders are doing this, this ain't good for the retail buyer. For the investor, we love it. Let's know in a second, guys. Said, you are right. So what's the pros and cons for the buyer? A good question. And I'll stop right here, guys, because he goes a little bit more on that one. And we'll get into some strategy stuff real fast. What's the pros and cons for the buyer? All right. Well, number one, the pro for the buyer is the retail buyer is you get the benefit of incentives. Let me give you an example of what's going on here in Dallas, specifically County. $35,000 toward your closing costs or toward the down payment. Accepting 100% gifts. So if someone wants to gift you the down payment, in the past, they wouldn't accept that, the lender. Now they will, right? Second lien financing. So you can get like an 85, 10 and 5, 85% LTV and then a 10% second lien mortgage, and then a 5%, you want to bring 5%, or a 95, 5 or 90, 10. That's how they can do a lot of things now. So they're being more flexible on you having to bring money to the table, or they'll just give you so many incentives that you bring nothing to the table. Again, I'll give you an example real fast. There are some people are actually putting down $0 down on an FHA project for new construction because of all the incentives the builder is giving. That's what's going down, y'all. Wow. This is whoo-wee. My word. So when D.R. Horton, the largest builder in America, it's on the alarm, it's for real. It is for you. You better watch out. You better watch out. Like this is, if you're a retail buyer. Here in a second for the investors. Now again, the con. The con for the retail buyer. Hold on one second. This is here. You get over leveraged. Same thing in 2008. As you buy over leveraged. Because you're so happy by getting a bad loan or a loan that you cannot afford. You get so happy that you grab for anything. I'm a homeowner for about 6 months. Okay? So that's the pros and cons of this whole scenario. If I am a retail buyer, what I would do, guys, is I would become a negotiating hawk. A hawk. I would negotiate on price point and then go after the incentives because they can't sell. You're the golden goose. You'll walk in and they'll say, this is our purchase price for this property. Great. I'll buy it for this price point. Nope, this price point. Now what happens is you can go back and forth, right? They say, you want to use our lender? If you use our lender, we'll give you this. Says, no, I use my lender and I still want that. Because you know they can't sell the property. Just become more of a negotiating hawk. That's all you have to do. This is not hard to do. That means you have to have a wise mortgage lender and a wise realtor for using a realtor. Right? And a wise appraiser, and you better get the property home inspected. And know that you want to move forward before you put down a deposit, because typically when it comes to new construction scenarios, those agreements are one-sided. Listen to me clearly, please. Those new construction agreements are normally severely one-sided to the builder. Now is the time for it to become one-sided for you, because they desperate. This is the first time since 2008, 9, 10, 11, 12, you can now apply the pressure on the new construction builders. Because why? They need you more than you need them. You can go out and buy you a property already built, right? You can go to another builder. That's it. Man, I hope you guys enjoyed that, guys. I did. Let's go to our second topic real fast. All right, guys. This one's going to be it's going to be just as important. Now let's go over to the Fed. The Fed, y'all. The Fed came out, guys, and the Fed, they did not cut the rates. This is Kevin Warsh. This is his first time doing this, guys. It's his first time. Second time him coming out talking about the rates. Okay, talk about the rates. Now, before we get to the video, guys, pay attention to what he says. He's totally different than the former Chairman Powell, but he's very specific with his words. Pay close attention, and I will dissect for you what he means. Okay, let's get into it. Let's get it. Let's go. Whoa, you go. Here you go. Let's go. Come on. There, here we go.
Good day. My second FOMC committee meeting as chairman has come quickly. It's probably too early to call it a streak, but our discussions again were collegial and constructive. I'm truly lucky to work with colleagues so capable and mission focused, and so determined, like I am, to sharpen the performance of the Federal Reserve. Today, as you know, our committee decided to vote by a 9-3 vote to maintain the target range for the federal funds rate at 3.5% to 3.75%. The committee is continuing its policy of making ample reserves in the banking system. The economy is showing impressive resilience. Even with recent shocks, the trends are positive and reveal solid growth. Job gains have kept pace with the workforce, and the unemployment rate has changed little. Inflation remains elevated relative to the committee's 2% goal. The committee remains resolute. You've heard this before, but we will deliver price stability. As before, the policy statement conveys just the facts. It's steering clear of forecasting.
Wow.
A choice we consider especially prudent at these uncertain times. Uncertainty, however, does not mean a lack of clarity. For some households, businesses, and market professionals, 5 years of high inflation have left a mistaken impression that's hard to shake.
Yeah.
That the Fed's implicit inflation target was somehow above 2%. Let me reiterate, there is no soft inflation target. There is no soft implicit target, not on this committee's watch.
So again, guys, he is a lot different than Powell. The reason I said it, guys, is because of the fact that notice he said he's not going to do any forecasting. Chairman Powell, back in the day, he would actually do a lot of forecasting based on tariffs. He gave strong language concerning what he thinks that the system is resolute and they will deliver price stability. Okay, giving confidence to a lot of maybe investors. then lastly, he talked about 2% being the target inflation rate that they want to shoot for. He came back and said that's actually not what they're shooting for. So he said, I believe it's a little bit flexible, I believe. So he's giving a different perspective than what Powell's doing, which is you're probably sitting in the market to where it's not as volatile right now. Powell, he would actually, and in my opinion, purposely come out and say this stuff just to be able to control the markets. That's just my opinion. I may be wrong, but they decided to pause the rates. Now, what does this mean for the retail buyer and or businesses? Well, this means for them is quite simple, right? Quite simple. What this means is, let me get rid of this real fast because he talks a little bit more. This means here, guys, is if you're looking to buy a new home, you better become a negotiating hawk. Ask for the moon and the sun. Okay. If you are a business, right, take advantage of those incentives when it comes to corporate finance. All money ain't good money. I'm not a big fan of MCAs. I've done one of those MCAs before, merchant cash advances. I'm not a big fan of those at all. I wouldn't do that at all unless you have a plan to pay back. Why did the circle bring in some wise counsel when it comes to funding? There's a couple of people that I can refer you to. And in a second, I'll give you a way to contact me and I can refer you to people. I make no money at all. It's all them. But I do want to give you people that I talk to for what I need for my transactions, right? That's for sure. But on the retail side, this is a great time for retail buyers that really want to go out and buy something. Go get it. Go get it. You have nothing to it but to do it now, guys. Nothing to it but to do it. Go get it because of the fact that you can. Most investors wish most investors, well, I would say most retail buyers, property, one second, property, gotcha. Most retail buyers, what they would want to do is they want to be able to make their own money or go out and get their own deal. Now's the time. Go make your own deal. Go make the sandwich. You got the power now. All right, guys. Hope that added some clarity to you. Now, let's go to the last topic for today, guys. Real quick, guys. All right. So here's the last topic. This is the most useful one. Get your pens passed out for this one, guys. The biggest bargain since 2008, I believe, yes. Distressed properties, stale listings, builder inventory, kind of going in the other direction. Let me get to my notes real fast. Let me see here. Landlords looking to exit. Yes, that is real. And properties needing renovation. Yes, and yes. This is the greatest time for creative financing deals. Creative financing changes everything. Let me let you know how, guys. All right. Let's bring in what I believe one of the GOATs in real estate, guys. Brother McElroy from the Rich Dad Company. He has, guys, he's forgotten more real estate than I know. And I know a lot of real estate by God's grace. This guy is one of the smart ones. And we're going to watch a little bit of this. And then I'm going to give you my opinion on what you should be going after. I'm going to give you some variables, what you'll be looking at. All right, let's get to it. Here we go.
So the question then is now a good time to start looking for bargains, or are you waiting a little bit for the cycle to continue to accumulate discounted properties? From the buyer's perspective, is it starting to be a buyer's market where, you can get some bargains out there that make sense, assuming you can cover the cost of deferred maintenance? Because that's going to come out of the price, right? I mean, you're not going to go out of pocket for that. So you're going to ask for a discount for, to be able to put the maintenance in, or, catch maintenance up where it goes. But from your perspective, is it look like maybe it's starting to becoming time to buy, or are we still too early for that, something like that?
It's 100% time to look, 100%
yes,
time to get your dry powder together for sure. Not necessarily the time to strike or act or buy, because a lot of that is predicated on the situation from the seller or the lender in this particular case. For examples, if you have a brand new Class A building, you personally, let's say you built this beautiful building at 200 units at $400,000 a unit, and you know it's and that's what your costs were. That property today is probably worth $250, $275 a unit. So you're not in a position to sell, and anybody knows that that property is going to be priced significantly below what it costs to build. And so the equity's gone for sure, and you might be actually negotiating with the debt. So if I'm dealing with you, you're obviously trying to sell and you're trying to cover your debt, and you're maybe even trying to get a little bit of equity out of it, but the market bears what the market bears. Now, let me reverse that. There are lots of situations where a lender has actually taken back an asset and it's sitting on their books. And so the person who used to own it is long gone, the equity's long gone, and now the lender is actually trying to figure out what to do with that asset.
Correct.
And again, the market is pricing it based on the market is. And so how does it price itself? What's the occupancy? What's the expenses? What is the interest rate? And in a lot of cases, Jeff, they're not even financeable, because obviously a lender is going to finance something that's stable. And so you've got all these scenarios. And so when you start getting into bridge or you start getting into short-term debt, it's priced higher. So which actually makes it worse for the project, because when you're buying something distressed, you don't want really expensive debt, like hard money almost. So it's this kind of catch-22 that everybody's in. The interesting thing is that the lenders are taking big haircuts. And so I'll give you an example. We have an investment committee that we meet with every week. In the last month, we had 2 assets, and we probably looked at 6 or 8 assets, but there's 2 of them specifically. One, we made an offer at $8,000 a unit. Now, let me just wrap your head around that. $8,000 a unit is below the land replacement cost. Now, here's the thing, 100% vacant next to a military base, and it's in Texas. And so the question would be, why would I ever buy anything like this, right? Well, because I know, because I've done it, I could spend maybe $20,000 to $30,000 per unit to fix that thing. It might take me 2 years, and my entire basis is going to be, let's just say, around $30,000 a unit. And so then I solve to the end, and then I figure out, is it worth it or not, right? So what would the market be today with today's rates, today's expenses, today's rents? My basis was $30,000 to $35,000 a door. And the answer on that particular one is it's around 60. So it's worth the short term. Now, it's not financeable. Have to buy it all cash, have to finance all the improvements.
You would have to be out of pocket for basically everything?
Correct. Yeah, because who's going to finance a 100% vacant deal that's in full distress? Now, there are ways to do that, and it's going to be expensive, but so that's part of what we're looking at. But the upside, of course, is when we stabilize that, if we get it, when we acquire it, we know that we're going to be way in the money. And there's some variables there that we could be off on even, right? Maybe it's $40,000 a door, but we're going to be fine on that asset when it's fully fixed and fully stable. The interesting thing and the irony is it's lender owned. It was purchased 4 years ago at $90,000 a door. Think of the people before us, right? The equity's gone. The lender is certainly taking a massive haircut, and who knows where all that goes. But we get this opportunity to fix it. And so those deals, they're not everywhere, but they're out there. You're dealing directly with the lender. And there's massive risk on our part, of course, because interest rates could keep going up. We might completely mess up the renovation. I have done this for 30 years, so we have a pretty good understanding of how to pull this off. I've certainly.
So, again, guys, Brother McRoy, he's one of the GOATs, guys. He is one of the greatest I've ever seen do this. He is that damn good. This is the reason why he has billions of dollars of assets under management. So, I gotta help you guys out real quickly as I'm ending this real quickly. Guys, this is, to me, the greatest time in history that I've seen outside 2008. I think even better than 2008 to begin buying properties. I always say you make money when you buy, not when you sell. So, this is the reason why I love distressed properties. I probably have, guys, have a plethora of deals I'm looking at right now that describe exactly what Ken was talking about in the residential space, in the commercial space as well also. And the numbers are amazing, which is pretty good. So what he's saying is spot on. Banks are taking a huge haircut because they have to. They have to because of the fact that a lot of these individuals, they are having to, the banks don't want assets on their balance sheet. They want them off. They want to give out loans, not manage properties, right? So that's the reason why they're taking a serious haircut. Now, don't get it twisted. They have insurance. Yes, they have insurance. So they're losing some money, but not a ton of money. But it's better for them to lose some money than a ton of money by letting the asset that's not producing any income that they can't make any money on sit in the balance sheet. So they take a little bit of haircut and get a portion of that money back via insurance, depending on how they structure their deal. Very simple, guys. It's not hard, guys. It's not hard at all. So again, what is a distressed property? Very simple. It is a burned down as a distressed property, high grass, chain link fences that look raggedy, wooden fences look raggedy, bad paint job, roofing issues, vacant properties. Now get this, guys. As I am looking through properties, I noticed that there's a lot of vacant properties in affluent areas. Let me say it again for the folk in the back row. There are a lot of vacant properties in affluent areas. Most investors just look at properties in depressed areas, and that may be the case for your business model, not for mine. I like those mid-tier areas, right? Not too affluent, not too depressed, just kind of right there on the line. That's me. Now, there's two types of distressed situations. You have a distressed property, which is what we're talking about, and also a distressed seller. Typically, if you find a property that is vacant or have some issues in an affluent area, you have a distressed seller scenario. I found a property in a very affluent area here in the Collin County area in Dallas, Texas, right? Very affluent area, $1 million homes, right? High grass. There's some water damage there, here and there, which is fine, but it's 100% vacant. Found out that the property was actually in a legal dispute right now, not from the seller or the owner and the builder. The lender. It was an investor and the lender, worth about $1.08 million. The debt on it is like $739. Crazy deal. I could put about $100K into it, right, to get it what I wanted to get to, if not even lower than that, right? ARV 1.5, 1.6. Do the math. From a retail standpoint, phenomenal deal. Quick question from Melody. Says, I would like to buy a commercial space / lot and repurpose it to be a vocational educational center for youth and ATL. Yes, that's cool. Now get this. Now, Melody, lean in on this one. Do you know what area right now is really struggling right now? The commercial real estate. COVID wounded them. You can get your crazy deal. Now you can negotiate. Now watch this. A lease to own scenario. If it's a lease to own, what happens is you put down a deposit. They actually build out your entire space for you, but you have an option to buy it if you want to at the end. But they paid to make it ready for what you wanted to do, not you. Now, if you can get a good deal doing it the other around, which means you get the money to build it out, go do it. But if not, be more creative. Another one, guys, is subject to investing, guys. Subject to investing, right? I'm gonna dive deep into that, guys. Most likely in another episode, because of the fact that right there, guys, is a great way to make a lot of money right now. Taking over somebody's payment, my God. Says really, I need guidance, Liddell, because the Hilton Foundation may fund it. Well, do me a favor, Melody, DM me. I'll take a look at it for you. No problem. No worries. And see if I can help out. And if I can't help out, point you in the right direction. But DM me. You and I can talk. No problem. I didn't know to buy a property and repurpose or buy land and build from a ground up. It depends on the deal and the area. All right. The deal and the area. Okay. I'm going to say it again. The deal and the area. Everything, the deal drives everything. Okay. It drives everything and the area, because is this a good area for you to be able to service your target audience? If the answer is no, don't do it. Find an area and a building that fits your mission. Make sure that you're looking at it from a mission or vision orientation. Does that make sense? Sounds good. Well, guys, I hope I added some value to you guys. Hey, real quickly, guys, if you ever want to talk to me, guys, like really talk to me, you can get me on Connect. I'm gonna use this real fast. Hold on 1 second. What's going on? What's going on with you, Alonzo, man? Good to see you, brother. If you ever want to talk to me directly, you can locate me, guys, on Connect, right? Connect. That is an app that PBD actually created, guys, and you can come talk to me anytime you want to talk to me, guys. It is me talking. You can send me a video message, DM, text message, you name it. We talk about business, finance, anything you want, marriage. It's all right there, guys. All right. Also, you may see this also on Instagram. We are giving away our free ebook called Distressed Property Investing, guys. It is free for the free. Okay. How to locate a distressed property in your city, county, or state. And let me give you guys a little bit of a secret. There is a technique in this ebook that talks about how you can get a list of distressed properties from your city for damn near free, whether it be commercial or residential. I said it with my chest. Okay? It's in this ebook, guys. Right there, guys. Go download it. Scan on the QR code right there on the screen, or click on the link below on the screen, or in the show notes, guys. Very simple. And then lastly, guys, digital banking, guys. I'm gonna say this is so clear. No problem, Melody. Thank you. This was helpful. Sounds good. DM me. I give you as much wisdom as I can. And I'm afraid to say I don't know. That's fine, guys. Digital banking is the most lucrative business model that no one's heard of. Digital banking. Let me give you an example real fast. SoFi is a digital bank. Chime, Venmo, PayPal, Stripe, those are digital banks, right? That's what they are. They are trying to take market share away from the traditional banks. Wells Fargo, Bank of America, Citi, PNC, right? And credit unions too. They're trying to take the market share from them through digital banking, guys. Digital banking, right? Let me give you an example real fast, guys. You understand that the average American, they use their debit or credit card to take care of life's expenses 30 times a month. What if you're making a nickel each time they actually swipe their card? Let's go a little deeper. People get paid direct deposit, right? Boom, there it is. What if you're actually getting paid just for their money sitting in their account? How about a credit card? Well, what if you can actually make some revenue on credit cards? It's called banking as a service. It's the most lucrative business model that no one has heard about. It's been around for a while now. All right. Well, guys, if you want more information about that, click on the QR code right there. Click on the link below in the show notes, guys, and go listen to the free information. It's free. Free information. It's free. All right, guys. Well, guys, thanks so much for your time. God bless you. Hope you guys have a phenomenal weekend. Hope I added some value. You know how to end it every single time. Before you leave, baby, while you can. You see that thing, baby. Take the picture for your mama now. And holla at you, buddy. God bless you guys. See you guys, but next week. All right, y'all. Peace.
Okay, so you did fixes and flips first, or were they? Now it sounds like you're more buy and hold. Okay, so you're wholesaling first. Okay,
because I was broke. I had no credit, I had no money, so I had to get some money coming in. So I learned how to do wholesale.
And you were doing wholesaling at the good time too.
2000.
When it wasn't so saturated. There was.
I kind of saw the debacle coming. Okay, it didn't make any sense. I was like, wait a minute, how can you lend out to retail buyers 99.7%?
Yeah,
just a little bit of a down tick. It's insolvent.
And you got to remember, in some states, because I lived in Florida at the time, you could have loan to value above 100% of your property.
Right.
The first property that I bought, it was 110%. We left the bank with like $30,000.
Yes.
Yeah.
Yes.
It was amazing to me. I was like, why am I not doing this all the time? But then clearly 08, 09 let me know why people shouldn't have been doing that all the time.
08, 09, that's why I made a lion's share of my money.
Wow.
People
Okay.
were actually running from the cows. I was running to it.
Of course.
Because I saw it was coming.
Okay.
A lot of my business colleagues back then were buying flippers.
Yeah.
I didn't think it was wise for me to share 50% of my profit with Uncle Sam. He didn't do no work.
Okay.
So why would I give him free money?
Of course.
Okay, how can I make sure I'm still legal, but keep the lion's share of the cash flow?
Of course.
So I began studying the tax code with my accountants and CPAs, and I said, okay, I'm going to buy a whole lot of properties. Now watch this. I actually buy a lot of properties, and I take home money when I actually acquire it. Every single time.
Okay, you need to break that down just a little bit.
If you'd like to learn how successful real estate investors make money when they acquire real estate and not when they sell it, click on the link below, swipe up, DM me the word to real estate to download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed. I'll let your partner and download the ebook today.
Right now, someone in your phone contacts is buying a coffee. Someone else just got a notification that their monthly subscription renewed. The average person taps their card more than 30 times a month and auto-pays nearly a dozen subscriptions. These are regular habits that lead to daily and monthly spending. But what if every single one of those microtransactions paid you? Introducing Dingo Blue, a powerful financial technology platform built for the way people actually live today. Powered by the ACN direct sales infrastructure, Dingo Blue gives your network a frictionless mobile account. 16.6 trillion. That's how much money is sitting in checking and savings accounts across the United States right now. Now, imagine getting paid when your customers simply do what they're already doing every day. When they keep a balance in their savings and checking accounts, you earn every single month a small percentage of what is in those accounts. When they tap their card for groceries, you earn. When they fill up their tank, pay their bills, grab a coffee, book a trip, or shop online, you earn. Every swipe, every purchase, every month. Every transaction creates another powerful opportunity to earn income through everyday purchases people are already making. Bills, gas, online checkouts, every swipe creates another opportunity. Dingo Blue aggregates those micro percentages, building a compounding residual pipeline directly to you. You acquire the customer once, you monetize their lifestyle indefinitely. No legacy fees, total transparency. Banking services are provided securely by our licensed FDIC-insured partner bank, giving your network institutional-grade protection. Stop funding someone else's success. Start creating your own. Tap into your pre-approved marketing toolkit, connect with your network, and launch your Dingo Blue engine now.
To learn more about this banking-as-a-service digital banking business model, and to see how it can potentially benefit you financially to build wealth, click on the link below, scan the QR code, or DM me the word bank. I'll send you the details. Stay blessed and holla at your butt.